Hello, my name is Julie Ramsey and welcome to Life Insurance Policy Options. Some key points in this session is what are dividends? Dividends are a refund of premium and they're issued by mutual insurance companies that are paid to their policyholders. There are 3 non-forfeiture options, and that's when the client cannot pay. Settlement options we'll talk about, and that's how the death benefit is paid out. To get started, let's talk about policy dividends. Now, a dividend, you'll see a dividend in participating policies. Participating policies are issued by mutual insurance companies. Sometimes mutual insurance companies are known as participating companies. What is a dividend? It's simply a surplus. It's a return of excess premiums. You see, the insurance company, they take in X amount of premium, and then they pay out expenses, claims, etc., and then they invest their money. And then however they invest in, they see what overall effect that has. And they'll say, gosh, do we have an excess? And if we have an excess, that goes to the policyholders in a mutual insurance company. They're determined, obviously, by mortality, interest, and expenses. Dividends are never guaranteed because they're a surplus. We don't know what it's going to be 20 years from now, 30 years from now. Dividends are never taxable. Why? Because it's a refund of premium. Now, there are different dividend options, and let's talk about those options. We're talking about a mutual insurance company, and how does that policyholder want to receive that dividend, assuming a dividend is paid that year? Well, the policyholder could say, I want cash. That's real simple. At the anniversary date, a check is sent to the policyholder. Interest only. Now, with interest only, it works like a savings account. So that dividend is placed, think of it like that savings account, and it will earn interest. Now, be cautious with this one. We said dividends are not taxable. They're a refund of premium. But with interest only, the dividend's not taxed, but the interest would be. So this is the only dividend option that has a tax consequence. Another dividend option is premium reduction. Simply the dividend reduces whatever premium is owed each and every year, assuming a dividend is paid. Or paid-up additions. With paid-up additions, if I understand the power of life insurance, why not take that dividend that I paid nothing extra for and have it go and buy paid-up additional permanent coverage? I don't have to go through underwriting. And then what happens is that little, think of it like a little baby whole life policy, that little baby policy will have its own dividends that it produces. So it has a real compounding effect. Or lastly, 1-year term. Let's take the dividend and let's have it buy term insurance, which would produce a higher death benefit, but obviously with term insurance there would be no equity. Non-forfeiture options. A non-forfeiture options, quite simply, is when the policy owner can't pay. Now, if you think about this, if you have a term policy, we said term insurance is like renting an apartment. There's no equity. So if you can't pay and you have a term policy, just like in your apartment, you'd be kicked out because you can't pay, there's no equity, you have to pay the premiums. There are no options. However, in permanent insurance is like owning your own home. Not only do you have that death benefit, that roof over your head, but you also have the equity, the cash value in that policy. So a non-forfeiture option is when someone can't pay their premiums. What options do they have? Well, let's go through this. There are 3 non-forfeiture options. Quite simply, probably the first one that comes to your mind, if the policyholder can't pay, cash it out. Cash surrender the policy, cancel it, because then that equity that's being built up in that policy, in that house, that cash value, is refunded to the policy owner. Obviously, the death benefit is no more, but they get something out of it. They get the equity out of it. Or reduced paid up. Now, with reduced paid up, let those keywords work for you. This is your cash value. This is how much you have in your policy. Here's your death benefit. You can't pay premiums anymore. So let's reduce the death benefit, and then you have that same coverage all the way out until age 100. So you have the same policy that you had, but because you can't pay, let's reduce the face and pay it out to age 100. Lastly, extended term insurance. Now, don't be confused between reduced paid up and extended term. With extended term, you have the same death benefit that you had before. So if you had a $100,000 policy, that death benefit is still $100,000. However, that cash value is buying like a single pay term policy. So we know term insurance is for a limited time frame. For example, let's say this cash value, say you've got $20,000 of cash value, you've got a $100,000 death benefit. Well, you're going to have this coverage, the same $100,000, but it's only going to last maybe for 10 years or 15 years or whatever those actuaries calculate that term will be. After the time frame, the coverage is no more because it expires. So there are 3 non-forfeiture options. Now, a settlement option. A settlement option, quite simply, is how a death benefit is paid out. And remember, death benefits are not income taxable to the beneficiary. That's what's so cool about life insurance. Now let's go through these different options. These can be set up in the policy either when you buy the policy, or if the policy owner doesn't select it then, quite often the beneficiary will decide at death how they would like to receive these funds. The first one is, and quite often used, is lump sum. And this is where the agent will go and deliver that death claim check to that beneficiary, and it's received income tax-free. Nothing is taxed to that beneficiary. Or you could have interest only. You know, this is where the beneficiary says, gosh, I don't know what I want to do with this money. You know, my world has been turned upside down. I don't know if I want to pay off the house. I don't know if I can live in this. I don't know what I want to do with this money. We can take that money, put it in like a savings account, money market account, whatever, but it earns interest. Or you could put it on fixed amount. This is where the beneficiary would say, I need a certain amount every single month, and I want to get that amount until it's gone. Fixed period, you know? I want to get money for the next 20 years, the next 30 years, spread it out along that time frame. Or lastly, I could go on life income. Life income would pay me money as the beneficiary as long as I'm alive. Now remember, with these settlement options, the death benefit is not taxed. However, the interest, in every single one of these settlement options, there would be interest tied to these, except for lump sum. Because your state will say if the death benefit's not paid out within a certain amount of time, we have to start crediting interest to it. So the only one that doesn't have income taxation would be that lump sum. So to recap, we said dividends are a refund of premium, right? And a mutual insurance company pays those to who? They pay it to their policy owners, okay? And we said those dividends, they're not taxable, they're not guaranteed, and we talked about the different dividend options. We said there are 3 non-forfeiture options. What is a non-forfeiture option? It's when someone can't pay their premiums. What can that equity, what can that cash value do for them? They can put it on cash, they can put it on reduced paid up, or extended term. And lastly, settlement options. What are settlement options? It's simply how the death benefit is paid out. Thank you.